Today we're uncovering whether Tesla is at a turning point or a breakdown heading into its July 23rd Q2 earnings. With deliveries plummeting, margins under heavy pressure, and the high-stakes launch of a live Robotaxi service, this quarter could rewrite Tesla's narrative. Stay tuned as I walk you through the latest data, what analysts expect, where the risks lie, and what numbers could make or break Tesla's stock. Hi everyone, welcome back to the Investment Diary. In today's deep dive, we're disassembling Tesla's upcoming Q2 earnings, covering the sharp drop in deliveries, the rollout of its Robotaxi pilot, AI initiatives, financial expectations, analyst sentiment, and the key metrics to follow when the report hits after the market closes on July 23rd. This is more than just an earnings report. It's a critical juncture for a company that has defined the EVA landscape and now seeks to redefine autonomy in AI. The market is watching closely, and so should you. Let's begin with vehicle deliveries, which have been a major point of concern. Tesla delivered around 384,122 vehicles in Q2, significant 13.5% drop year-over-year compared to approximately 444,000 units last year. This marks the steepest year-over-year decline in Tesla's recent history, a stark contrast to its previous rapid growth. This slowdown isn't happening in a vacuum. It reflects intensified competition, particularly from aggressive Chinese OEMs like BYD, which have now surpassed Tesla in global sales volume. We're also seeing the impact of Tesla losing crucial USF tax credits, which has forced the company to engage in more aggressive pricing strategies to stimulate demand, further squeezing its already pressured margins. Beyond external pressures, there have been some noticeable internal shifts. We've seen departures among senior executives, including the North American sales VP, amid ongoing internal turnover in key areas like AI. Engineering, an HR. This kind of executive shakeup often suggests internal disruption or a strategic realignment, which can add another layer of uncertainty for investors already concerned about sales performance. The question is, how much of this is part of a necessary restructuring for Tesla's future vision, and how much is a symptom of underlying issues? Now, let's pivot to what many believe is Tesla's future, its Robotaxi and AI ambitions. The headline-grabbing news this quarter was the launch of Tesla's Robotaxi pilot service in Austin on June 22nd. This wasn't a full-scale rollout, but rather a limited fleet of 10 to 20 Model Y cars, operating with safety monitors on board, taking paid rides at $4.20 a pop. However, early reports from these rides have been far from flawless. We've heard anecdotes of software glitches, instances of wrong-way driving, phantom braking, and even traffic violations. These issues immediately raise regulatory and reliability concerns, putting a spotlight on the safety and maturity of Tesla's full self-driving technology. This is critical because for Elon Musk, the future value of Tesla isn't just about selling cars. It's intrinsically tied to its AI ecosystem. He continuously emphasizes FSD, the broader Robotaxi network, the development of humanoid Optimus robots, and proprietary Dojo chips as central pillars of the company's future value proposition. The success or failure of the Robotaxi deployment, even in its early stages, will be closely scrutinized as a barometer for Tesla's grand AI ambitions. Investors are looking for tangible progress and reliable performance, not just promises. Any updates on how they are addressing these early glitches and their roadmap for broader deployment will be paramount in the earnings call. On the financial front, the picture remains challenging. Tesla's Q1 automotive margins fell sharply to approximately 16.3%. This is a significant drop and signals the intense pricing, pressure, and competition the company is facing. The full-year revenues are now projected to decline for the first time in 5 years, which is a major red flag for a growth stock like Tesla. Adding to these financial pressures are macro and political distractions. The loss of critical EV tax credits in the U.S. has a direct impact on the affordability of Tesla vehicles for consumers. Export tariffs and broader trade tensions, especially with China, further complicate Tesla's global manufacturing and sales strategy. Moreover, Elon Musk's increasingly public and often controversial political activities are affecting brand perception, which can have real-world consequences on consumer trust and sales, particularly in certain markets. However, it's not all doom and gloom. Tesla's energy business has emerged as a significant bright spot. Energy storage deployments hit a robust 9.6 gigawatt-hours in Q2, representing impressive growth of approximately 20% year. This segment, encompassing products like Megapack and Power, provides a vital diversification of revenue and could offer a crucial cushion against the softness in the automotive division. The market will be watching to see if this growth momentum is sustainable, and if it can truly offset some of the struggles in Tesla's core vehicle sales. So, what should we expect when Tesla reports its Q2 2025 earnings after the market closes on July 23rd? Analysts have set some clear expectations, which will serve as benchmarks for the market's reaction. For earnings per share, The consensus estimate is around 39 cents to 40 cents. This would represent a significant year-over-year decline of approximately 20 to 25% from Q2 2024's EPs of around 52 cents. In terms of revenue, analysts are projecting figures in the range of $22 billion to $22.5 billion. This translates to a decline of roughly 12 to 15% compared to the prior year, primarily driven by the aforementioned volume declines in vehicle deliveries. When the numbers hit, here are the key areas you need to watch closely. Firstly, vehicle delivery trends and average selling prices. Did the price cuts achieve their desired effect on sales volume? And at what cost to profitability? A surprising stabilization or slight uptick in ASPs, despite volume pressure, could be a positive signal. Secondly, automotive gross margin. After a concerning dip to 16.3% in Q1, investors will be desperate to see any signs of stabilization or, ideally, an improvement in this crucial metric. This will indicate how effectively Tesla is managing its costs and pricing strategies. Thirdly, Robotaxi updates with specific KP, as this is arguably the most anticipated part of the report. Investors will want more than just anecdotal reports. Look for specific key performance indicators like daily ride, volume, expansion plans beyond Austin, and concrete steps being taken to address software glitches or safety concerns. Any indication of a smoother, more scalable rollout could be a major catalyst. Fourthly, FSD Cybercab guidance or pipeline metrics. What is the timeline for a broader FSD rollout? And are there any updates on the long-term vision for specific regulatory outlook or progress on that front would be impactful? Fifthly, energy storage and services trends. Can the strong growth in the energy business continue to provide a meaningful offset to automotive weakness? Look for revenue and margin growth in this segment. And finally, cash flow and capital expenditure outlook. With massive investments earmarked for AI, robots, and potentially new vehicle platforms, how is Tesla managing its cash flow? Any changes to CAPEX guidance will signal the pace and scale of these ambitious projects. The analyst community is clearly divided on Tesla's prospects, reflecting the complex and often contradictory signals the company is currently sending. The average price target consensus sits around $296.60, with a remarkably wide range from a low of $115 to a high of $500. This wide dispersion underscores the fundamental disagreements on how to value Tesla, particularly its long-term AI and robotics potential. On the bearish side, firms like JPA Morgan have set a low target of $115, while UBS is around $215. These bears are likely focusing on the immediate challenges, the sales slump, margin compression, and the regulatory hurdles and safety issues facing the Robotaxi rollout. They see the core automotive business struggling and question the timeline and profitability of the ambitious AI ventures. Conversely, the bulls, notably Wedbush and ARK Invest, are much more optimistic. With targets reaching as high as $500, their bullish thesis is almost entirely predicated on the long-term potential of Tesla's AI and robotics divisions Robotaxi and ASPs. They believe that once these technologies mature and scale, they will unlock immense value, far beyond just car manufacturing. This mixed outlook creates significant volatility around the stock, with a cautious tone from some firms like Baird and UBS, while the long-term vision keeps the bulls hopeful. It's also worth noting some interesting investor activity ahead of earnings. ARK Invest, a prominent Tesla bull, recently acquired approximately $36 million worth of TSLA stock, signaling their continued conviction in the company's long-term strategy. Even amidst current this kind of institutional vote of confidence can sometimes influence market sentiment. Understanding the potential upside catalysts and downside risks is crucial for any investor. Let's start with the risks. Continued delivery drop and margin erosion. This is the most immediate threat. If Q3 deliveries show further significant declines and margins continue to shrink, it will be a major blow to investor confidence. Negative headlines on Robotaxi safety. The early glitches are concerning. If more serious incidents or regulatory pushback occur, it could severely delay the Robotaxi rollout and undermine the entire autonomous drive-in narrative. The market is very sensitive to safety concerns. Regulatory tariff pressure on tax credit access. Ongoing trade tensions and the removal of EV tax credits could continue to weigh on Tesla's sales and pricing power, especially in key markets. Musk's political distractions harming brand. As discussed, Elon Musk's public political commentary and activities have raised concerns about brand perception and could lead to further consumer backlash or regulatory scrutiny, impacting sales and market access. Intensified competition. The EV market is no longer Tesla's sole domain. New players are emerging with competitive offerings, forcing Tesla to innovate faster and potentially sacrifice more margin. Now for the potential catalysts that could send the stock higher. Smooth Robotaxi rollout or upgraded software. If Tesla can demonstrate significant improvements in the Robotaxi pilot, such as expanding the geofence, removing safety drivers, or showing compelling safety data, it could be a massive positive. Even a small software update that dramatically improves performance, like the recent one for pickup locations, can generate excitement. Recovery in average selling price and gross margin. Any indication that pricing power is returning or that cost efficiencies are improving would be warmly received by the market. Strong energy storage segment growth. Continued robust performance in the energy storage business, potentially exceeding expectations, could highlight this segment as a consistent and growing revenue stream. Assurances on future product lines, including affordable vehicle. Investors are eagerly awaiting concrete updates on the planned affordable vehicle, often dubbed the Model 2, or Cybercab in some contexts, and other future product pipeline details. A clear roadmap for these products could reignite growth expectations. Positive guidance on achievable milestones for FSD development and monetization could shift investor focus from current automotive struggles to future software revenue. This earnings report is genuinely pivotal for Tesla. A strong beat on expectations, particularly if accompanied by a bullish and credible update on Robotaxi, could very well reignite the rally and push the stock back towards the $300 level, validating the long-term bull thesis. It would signal that Tesla's pivot towards an autonomy is gaining traction and that the automotive slowdown is a temporary hurdle. However, if Tesla delivers weak results, missing on EPs or revenue, and offers no clear compelling path forward on autonomy or margin recovery, the downside risk toward $200 or even lower is very real. This would confirm the bears' arguments that the company is struggling with core demand, and that its future bets are too speculative or too far off to justify the current valuation. Positioning heading into this earnings call depends heavily on your risk appetite and investment horizon. Bulls might see any post-earnings dip as a buying opportunity, especially if they believe in the long-term vision for AI and robotics. They might be willing to stomach short-term volatility for potentially significant long-term gains. Cautious investors, on the other hand, should likely await more concrete validation of the Robotaxi program's safety and scalability, or a clear turnaround in automotive gross margins, before adding to their positions. The prudent approach might be to wait for the dust to settle and for Tesla to prove its execution capabilities in these critical areas. Tesla is truly at a crossroads, navigating a challenging sales downturn, ongoing internal shakeups, and making massive, high-stakes bets on AI and robotics, all converging with this July 23rd earnings release. I'll be here, live after the numbers drop, to break everything down and provide actionable insights. Let me know in the comments. Are you leaning bullish or bearish on Tesla? If you enjoyed this deep dive, hit like, subscribe, and ring the bell to catch my live earnings reaction. And drop a comment with your TSLA target. Tell me where you're positioning for the rest of 2025. Thanks for watching the Investment Diary. Stay smart, stay invested, and I'll see you after the bell.